The very nature of Bitcoin's decentralized network is it is secured by a massive decentralized network of miners, as I mentioned earlier on, which he referred to as the Bitcoin security data centers. Now, miners do generate a high hash rate, and what that means is it ensures that the network's integrity and resistance to attacks. I think that's the key point. The higher is the hash rate, the more secure, the more resilient is the Bitcoin network. And this is an important ingredient for investors like you and I that we should really value the most, particularly when we're analyzing the investment potential of Bitcoin itself. Also, coupled with that are the incentives. What are the incentives for Bitcoin miners to continue to mine new Bitcoins? Well, he made a mention on the concept of a block reward, which is true that it reduces over time, because during the 4-year halving cycle, the block reward gets halved. It's currently sitting at 3.125 Bitcoins for every new block that is mined every 10 minutes. And also, there's a notion of transaction fees. Now, he made an interesting analogy here and it's true, the scarcity effect of mining new Bitcoins, when it becomes more pronounced and more scarce over time, because the block reward gets halved closer to zero, and I think by the year 2140 it gets set to zero. And I have actually made a video explaining where in the Bitcoin source code, where the actual critical function that is responsible for controlling the 21 million Bitcoin hard cap limit. So I suggest that you subscribe to this channel and tap into that video. That gives an extra explanation as to what I'm talking about here. The block reward will eventually get to zero, which would mean that no more new Bitcoins will ever get produced once it reaches the block reward to zero, which at that point, if you sum all of the block reward subsidies, it will add up to 21 million. That is the ultimate feature and interesting aspect that Bitcoin as a value proposition provides to us investors. So that is an important point to make. And at that point, since there are no block rewards being issued, well, subsequently there will be inevitably that competition for settlement transactions, right? So this is governed by transaction fees, which is explained that, once that happens, there'll be that competition to use the Bitcoin blocks in its network for settlement transactions purposes. And the fees will be interesting for the miners, because where there is demand for using blocks to manage transactions in the Bitcoin network, well, inevitably that will have a knock-on effect on the cost of the transaction fees will obviously go up or shoot up as a result, which makes total sense. And I actually agree with Michael's analogy and explanation on that. The sustainability of the mining. What is the continuing incentive for miners to continue to use in their investments to mine new Bitcoins? Well, it is actually a sunk cost. And that in itself, they're actually incentivized to continue to use the mining operation to mine new Bitcoins, even at a reduced profitability. But that's not so much of an issue, because as I mentioned at the very start here there is stranded and wasted energy out there, no matter where you are, whether it's in the emerging world or in the advanced economies. There is an example of that is unused dam electricity, so hydroelectricity in surplus capacity in various parts of the world. The same can be said around flared gas. Now, these are just examples of surplus energy which can easily be redirected to Bitcoin mining rigs to help them continue mining your Bitcoins at a reduced cost. This is the key point, and this is the key driver and incentive at the end of the day for these Bitcoin mining companies. Also, he went on to talk about the reduction of semiconductor cost, which makes sense, because as the technology becomes more available in the mainstream and everyone is buying into it, then it becomes more of a commodity, and by its virtue will reduce the cost of the Bitcoin mining equipment over time, which certainly helps ensure its long-term affordability. So I would expect the Bitcoin mining rigs, when they need to refresh their equipment, they'll be able to do it at a much more affordable basis. This is facilitated and supported by the semiconductor manufacturers that will be able to produce new mining hardware at a lower margins, maintaining supply even as the older rigs burn out. And finally, the other point that I find it interesting is the market dynamics and resilience nature of the Bitcoin network. As Bitcoin mining adapts to market conditions, miners with high cost will exit and more efficient operators will continue its course. Well, that in itself would further incentivize mining operations, which will inevitably help ensure its sustainability and longevity of the Bitcoin network overall, which, as I said before, are fundamentally supported by Bitcoin mining operations, and also the participant nodes in the network that are used to validate new transactions that are settled in the network. So this is very important, and this is the beauty of the elegancy and design of the Bitcoin security network itself. Bitcoin's network is fundamentally designed to incentivize continuous investment in security infrastructure. Now this means that this system channels resources into defending users' economic rights against potential threats. This is the ultimate key, and this is the ultimate reassurance that I want to leave you today for the investors out there. Better position you to make that informed decision to invest part of your portfolio into Bitcoin, which I'd encourage that you do in line with your risk appetite. If you enjoyed today's episode, please don't forget to hit the like button and share the video to your friends and colleagues at work. And if you haven't done so already, please subscribe to this channel, as I regularly post some interesting videos such as these, anything to do with Bitcoin, blockchain technology, and the future of finance. So I'll see you next time.